So what's gain? I'll say this. The great thing about my job is gain is only important from the perspective it justifies a transaction. I don't have to figure this stuff out. With that said, every day I go through this every day with people, pretty much every phone call I'm on. Because I want to know whether the exchange makes sense. I want to know what that person has. I want to know what the property is. I want to know what they paid for it, what they put into it during the time they've owned it, and so on and so forth. So gain is simply the adjusted sales price minus the basis on the property. What's your basis on the property? Purchase price plus capital improvements minus depreciation, in a nutshell. All right? Once again, you want to talk to your tax people, get their perspective on things and understand exactly what your obligation is. But this is how quickly it changes. Remember I talked about gifting? If I gifted a property to a kid of mine, what would their basis be? It would be what mine was. If they inherit it, they get the stepped up basis. If I bought the property, so I said basis is purchase price plus capital improvements minus depreciation. My point is, depending on how you receive that property, that initial number varies dramatically. What if you did an exchange into it? You had a basis carry forward. 1031 is a tax deferred exchange. It's not a tax-free exchange. I hear people say tax-free all the time. It's not. Tax deferral, basis gets carried forward, gain goes forward. 1034, anybody remember 1034, the old residential rollover? So in, was it 97, we had that change from 1034 to 121. 1034 was a rollover. You sold your home, you had 2 years to buy a new home of equal or greater value. If you're 55 or older, you had a one-time exclusion of 125 in gain. The reason I bring that up is we had a basis carry forward once again. So depending on how you got that property, your basis is, that initial acquisition price is going to vary. You pull it out of your pocket, that's what you paid for it, that's that initial number. You exchange into it, you had basis carry forward. 1034, basis carry forward. Gifting, the person that granted the gift, their basis. Inheritance, stepped up basis. So that number can vary dramatically. Plus improvements. So I talk to people every day and I say, okay, so during the time you owned the property, did you do any capital improvements? Oh yeah, I did this, did that, did all these different things. So well, did you write off anything? Oh, I wrote it all off. What'd they do? They expensed it. They didn't capitalize it. Expensing, you write it off, does nothing for your basis. Capitalizing does. Depreciation. Did you take depreciation? So this has been a rental house for the last 10 years for you. Did you take depreciation? No, I didn't do it. What's the government's position?
You got to take it.
You should have, therefore you did. So maybe you didn't even get the benefit of it, but they're going to say, they're going to treat you as though you did. So that's even worse than the other. But the bottom line is you've got depreciation that's going to be on that. If you just bought a property, an investment house, for example, and never rented it, you're not going to take depreciation on it. It's just sitting there. But you start renting it, you've got to take the depreciation. Yes?
But let's suppose you start with one thing, and then 30 years later, that thing gets swapped to, say, property number 6 or 7. All right? And supposedly, your basis carries forward. Who besides you is keeping track of that?
Nobody. I mean, your tax people, every time you do an exchange, well, I shouldn't say that. Federal government, every time you do an exchange, the year in which you do the exchange with your tax return, you're filing into 8824, which is a basis carry forward calculation. So that thing accompanies it, but as far as going back.
Yeah, how do they go back? So what's to prevent you from making a mistake on the basis calculation?
Well, if you made that's the thing. If you made the mistake long enough ago, then you're fine, right? Because they can only go back so far. So, but you know, once again, that's why you want tax people. I want tax people anyway, because I don't want to have to deal with that stuff, right? I want somebody there that if it's questioned. And when we're looking at, just think about that change, that drop and swap. I talked about changing ownership. You know, what happens with that? If somebody questions it, I want to make sure that's done. If we change your home from, well, let's say you take your home and convert it into investment, or we take an investment and convert it into your home. We can go both ways on it. But those things, there's no tax consequence on the conversion, but there is potentially downstream if we're not careful with what's going on. So, you know, this is why, you know, a flat tax, how can you argue against a flat tax, right? I mean, it's just straight, it would be simple. But what are most politicians? Lawyers, right? And
what percentage of legal practice is estate planning or tax planning, and back to the tax world too. So you think about that stuff, you think about deductions, you think about write-offs or any number of things that go on, but it's complicated. It gets very complicated very quickly. So that's why, you're always looking at maintaining records the best you can. And I've had people, I say this in the presentations, I had one gal I'll never forget. She got the property, so I'm going through this stuff with her. So, well, what's your basis? Well, I don't know. What do you mean you don't know? Well, my husband gave it to me. Well, can you talk to him? No, he's incarcerated. Well, where did he get it? Well, he got it from a buddy who's incarcerated. So it's like, what was my advice? I mean, okay, let's go talk to some tax people so you're not going to be incarcerated. Let's do that. So the deal is you got to fix it the best you can and do it and support it and make sure you've got a reason. If you're making changes and stuff, make sure you've got a reason to do the stuff. There's a bold down there that says phantom gain, and I think this is something that's really important, something that people do not understand. On a home, so unfortunately the last decade's been pretty tough on a lot of people, right? We had a lot of foreclosures, a lot of things happening. If you had a home foreclosed, you've got some tax relief on that foreclosure. On income properties, you don't. Income properties, sort of the ultimate slap is you could lose a property to foreclosure and pay for that privilege. So what I mean by that is, in a foreclosure, the government treats the sales price, the debt on the property is the sales price. So if the debt exceeds the basis, the delta between the debt and that basis is gain. So, and believe it or not, I think we've got 2 more properties that we're expecting to go through this, big properties like this, being foreclosed before year's end. And what happens is we end up getting involved in the transaction just pre-foreclosure, so that when the property is foreclosed, our client has been removed of any actual debt relief. And that's what we're talking about, triggering the gain in that situation. And their choice is this. They lose the property and pay tax for that privilege, or we set up an exchange. It's really sort of funny because we don't get any money. We just have an exchange agreement in place, an assignment of membership interest. That transfers the asset when it's foreclosed. We've just isolated our client from debt relief. And that date of transfer, the date of assignment starts at 45-180. And for our clients, it's a pretty easy choice. If they've got money to go forward, their choice is, hey, I'm going to pull money out of pocket, pay the tax, and get nothing, or I can pull roughly the same amount out and go get a property. So they'd obviously rather do that.